Only 1 year ago, many investors thought that banks were a very good bet on global economies. And it's only over the last 6 months that this opinion has changed. Banks have started to underperform. They're actually down 10% year to date. And the valuations of banks are roughly 20% below their long-term average. So why has this happened, especially as many central banks put in a lot of liquidity and the banks should profit from that? In general, the profitability of banks goes hand in hand if the price of money increases over time. So what banks will do is they will take the short-term available funds, they invest it in the long-term funds. Currently, the spread between the short and long-term is roughly 100 basis points. Now, we have seen in the past that this spread was 60% higher than it is currently. So profitability was higher in the past than today. The low oil price has had a special effect on banks in the US because banks in the US have had a big exposure by providing debt to the oil sector. Now, we have seen oil moving from 127 US dollar per barrel down to 27 US dollar per barrel. And you perfectly can imagine that there's a lot of distressed debt in the circuit. Now, thanks God, we are now north of 40 US dollars per barrel. Nevertheless, we will see a lot of non-performing loans, and investors have shunned, therefore, US banks because this impact is enormous. European banks have not been able to take advantage neither of the re-emerging economic growth, nor of the very positive actions by the European Central Bank. What we have seen in Europe is that since 2014, banks did actually do pretty fine. It was only in 2015, in the midst of 2015, when commodities and crude came down, US banks started to underperform, and finally, also European banks started to underperform in tandem with the US banks. So when the market started to look more cautiously at European banks, they saw actually there was an erosion of net interest margin, which is a key provider of profitability of European banks. Now, why did we see this erosion? Clearly, the European Central Bank introduced negative rates, and this was not good for the profitability. So an action which was thought initially to be very positive turned out to be negative for banks. In China, a lot of hard facts are very difficult to come by. So if we just look at the 4 largest banks, which represent 700 billion of market capitalization, but their loan book on their balance sheet is roughly 6,600 billion, and those 6,600 billion represent roughly 40% of total banking assets. Now, what we have seen in China is the slowdown is real. And what we are afraid of is that the slowdown will accentuate. If this will happen, up to 30% of the loans need to be written off. For those 4 banks, it means 1.8 trillion in dollars. And what we have realized is that the regulator faces this by decreasing actually the capital buffer. The capital buffer in China is the reserve requirement ratio. This doesn't really make sense. And as a consequence, investors value Chinese banks nowadays half of any global bank. We definitely see the prospect of some cyclical rebound, especially in the US, as oil finally seems to stabilize. In Europe, we follow the ECB, who basically told us that by 2018, 2019, inflation in Europe will be back at 2%, which means also we will see higher rates, and higher rates means higher profitability for banks. So overall, yes, in the short to mid-term, we clearly see an investment case for bank, and we would recommend our clients to buy those banks.